Good morning, everyone. Welcome to Ainsley News. It's Wednesday, the 25th of August. Why the fastest doubling of the S&P 500 portends trouble ahead. Indeed, it does. COVID and the response by central banks and governments alike have rewritten the record book in so many ways. Last week, just 354 trading days from the bottom of the deepest but shortest recession in history, the S&P 500 doubled in value from that 23rd of March 2020 low. That rally to double is the quickest since World War II. Here's a chart here for some perspective. And this next chart we're going to show you just shows how quick this was compared to previous doublings. This is officially the fastest bull market to double off the lows. Lance Roberts from REA then puts these rallies into perspective by broadening the picture around what happened before and then after these epic rallies. The chart we're going to show you next shows the S&P 500 in real terms via the master, Dr. Robert Shiller. The red bands in this next chart mark each doubling event from a preceding low. That looks very sharp at the end there. Looks like they're getting faster and faster. These are all listed off here. So 1949 to 1956, the market rallied further before declining by 20%. That correction led to a second double that coincided with a level not revisited until the mid-1980s. The 1974 to 1980 market doubling. The market double followed one of the worst bear markets in history. Unfortunately, the entire gain on an inflation-adjusted basis was lost by 1982. The 1982 to 1987. The crash in 1987 followed the rally from the 1982 lows. The 1990 to 2000. The market doubling in the 1990s ended in the dot-com crash. 2002 to 2007. Following the dot-com crash, investors who just recovered losses got hit by the financial crisis. 2009 to 2020. The liquidity-driven rally from 2009 lows is the strongest advance in history. The March correction surprised investors, but the pump-off liquidity revived the animal spirits. 2020 to present. The fastest doubling of the market in history occurs at a time of peak valuations, economic and earnings growth. It's worth noting that despite 4 doublings from the lows, investors in 1905 didn't break even until 1955. That's 50 years of zero returns. A critical piece of context for this rally, as noted previously, is that it started with valuations already high. While the jump in earnings and profits surged from the pandemic lows, valuations were not allowed to revert, as would typically be the case during a recession. If valuations corrected during the pandemic-driven shutdown, as prices fell and earnings surged, a more sustainable case might exist. This is clearly depicted in this next chart we're going to show you here, showing real S&P 500 versus valuations. That might be more palatable if we were not seeing very clear signs of an economic slowdown ahead. In the US, consumption accounts for 2/3 of GDP. Raoul Pal, in his latest Macro Insiders In Focus report, had this brief reminder. Nothing better sums up what's going on than this chart of the SPX versus consumer sentiment. Here's this chart here showing that disconnect there. I see no other outcome than a reversal of the tapering talk or on the tapering talk, and in fact a shift to new stimulus. The new Powell pivot is coming, and it's not news to the bond market. Every single post-recession period has seen a 10-year yields rise and then collapse. The market is always too early in forecasting a self-sustaining recovery, and this time will be no different. Here's another chart here from Raoul Pal. Just as bond yields rolled over in March, so too gold bottomed and has been trending up ever since, albeit with a fair bit of chop. From the Aussie dollar low of 21.89 to the current 2,500, we've seen 14% increase in just 5 months. Powell often calls the bond market the moment, or market of truth. Gold still has some ways to catch up to the usual correlation between the two. Regardless, both are telling you there is trouble ahead and their safe haven properties are being bought up by the smart money. This from Powell. I think 10-year yields fall to 1% and pause. After that, we can see if the slowdown is really significant, in which case rates will fall to new all-time lows. If investors realize the economy is not self-sustaining, I think they will entirely reprice the yield curve. And before you dismiss this as a US-only thing, if the S&P 500 catches or crashes, so do we. And the latest IHS Market Flash Australia Composite PMI released Monday plunged us into a double-dip recession, while the ASX 200 remains sky high. Just as Powell expects bond yields to tank towards negative, if you missed our article in news on Monday, the prospect for Australia is very much real too. Reality will always catch up. Thanks for listening to today's Ainsley News, everyone. Remember ainsleyBullion.com.au for all things physical, gold, silver and platinum, ainsleywealth.com.au for all things cryptocurrency, and goldsilverstandard.com for our own crypto built and backed by real gold and silver. We'll catch you tomorrow, everyone, for more news.